to be here. Thanks for having me and welcome everyone. This presentation is just going to go over some of the aspects of the current macro environment because obviously, there are decades where you can ignore macro and just focus on specific investments, specific kind of niche areas, and the macro won't affect you too much because it's just kind of like a long trend. There are other big turning points in macro where the macro dominates individual investment decisions, and so my argument for a while has been that this is one of those decades, and obviously recent events, including all the way back to COVID, and then of course recent events in Ukraine, further complicate that and further show how important macro is in this rather highly levered, increasingly inflationary type of environment. So I'm going to show a couple charts here to show kind of a big picture where we are in the macro landscape and how it might help inform our investment decisions. So, to start off, we can zoom in, traders and investors often mix up their time frames, right? So there's cyclical shorter term stuff, and then there's longer term structural stuff that often gets ignored because it only shows up in history books. And so first, if we look at the normal cyclical stuff, the US and large portions of the rest of the world are in a pretty clear cyclical slowdown. So, we were slowing in the 2018, 2019 environment leading into COVID. And then, COVID really kind of blew a hole in that. And we've, due to large fiscal stimulus and a rebounding from that, there's, kind of 2 years of recovery. And ever since around, late 2021, a lot of cyclical indicators have been rolling back over. So this is the Purchasing Managers Index, which is just one rate of change indicator. Generally, when it's above 50, that means the economy is expanding. When it's below 50, it's contracting. And as you can see, we're still growing at a positive rate, but we're decelerating. And that's a story for Japan. That's a story for a lot of countries around the world, with some exceptions such as Brazil or China. They really had a lot of pain last year, and if anything, might be turning up. And so the world's not fully synchronized, but large portions of the Western world are synchronized, and they have a very large impact on global GDP, and then of course their own markets. So that's one thing to keep in mind going forward of where we are in this macro landscape. When we zoom out super far, though, one of the big themes I've been presenting for the past 2 years is that in many ways the 2020s are shaping up to look a lot like the 1940s, and unfortunately it keeps getting more and more clear, right? So we have the high inflation that we had in the 1940s, and now unfortunately there's kinetic war and kind of increasing levels of protectionism around commodities and things like that. But mostly when I started making this comparison 2 years ago, I was focusing on the fiscal and monetary policy cycles. This was inspired by the work of Ray Dalio, and then I further expanded on it and tried to look at it from other angles. And essentially, to go over what these two charts show, the one on the left is debt as a percentage of GDP. And so the orange line is non-federal debt as a percentage of GDP. So that's mostly private debt. And the blue line is federal debt as a percentage of GDP. And generally, these, in the long-term debt cycle, these go through kind of 1-2 punches. So basically what happens is you get more and more debt until you hit zero interest rates. And then it's really hard for policymakers to accommodate any more debt accumulation. And so you start to get different policy environments. And so back during the Great Depression, going into the early 1930s, you had a rising debt bubble. And then that started to pop, partially because debt got extremely high, and then you had a GDP contraction, so debt as a percentage of GDP skyrocketed, and they devalued the currency, printed a lot of money, and then you had a period of kind of stagnation, rising populism around the world, and then that unfortunately led to war. And during the war, of course, you had a massive fiscal impulse, and that was quite inflationary. And because the federal debt as a percentage of GDP was so high, they held interest rates low, despite the fact that inflation was running hot. And so you end up inflating a lot of that debt away. And so as you came out of that, partially because they had a lot of growth and austerity after the war, and also because of inflation throughout the war, they reduced debt as a percentage of GDP, not by actually reducing the debt, but by increasing nominal GDP through growth and inflation. And we look at it from another angle. So this is a century of US monetary and fiscal policy. Interest rates at zero for the first time, going into the early 1930s. And so they resorted to the blue line here, which is the monetary base as a percentage of GDP. So for lack of a better word, printing of base money. And so throughout the 1930s, you had that, zero rate environment. You had, expansion of the monetary base. You had larger fiscal deficits, which are these gray lines. And that was a rather stagnant environment overall. And then it was the 1940s where you really had the more explosive outcome. You had huge fiscal deficits to fight the war, and you had inflation because of that. And yet they held interest rates super low anyway. And so you had basically deficit monetization, you had inflated the debt away, and that started a new cycle that corresponded with, the next cycle of credit expansion. And unfortunately, we started to see a lot of parallels over the past 15 years or so. And so interest rates at zero for the first time in 2008 since the Great Depression. And you had an explosion of the monetary base as a percentage of GDP compared to a long period of down to sideways monetary base. They had to resort to that tool. We today we call it quantitative easing. They didn't call it that back here. And then now with the COVID era, we have a huge fiscal deficits again, even bigger than the ones we had in that crisis. And so the whole comparison I've been making is that the 2000s were in many ways like the 1930s, and the 2020s are shaping up to be a lot like the 40s, which is a more inflationary and fiscal heavy environment. And it's something to be aware of going forward because no analog's perfect. There are many differences between now and the 1940s, obviously. But it's one of those things where the more we understand that environment, the more we can see the exceptions, the more we can navigate this environment and understand what kind of things that are in store for us. And one way to encapsulate that is the difference between the 40s and the 70s in terms of inflation and interest rates. So a lot of people, when they think of high inflation, they think of the 70s. So on the right here, I have blue line is CPI, red line is 3-month T-bill rates. It's a proxy for short-term interest rates. And you can see that as you had these inflation waves, the Federal Reserve is trying to raise interest rates to contain it. And eventually Paul Volcker succeeded. He basically put the economy into a double recession, and they stabilized the dollar. They had very positive real rates. So the red line was firmly over the blue line. In the 40s was a very different environment because, in the 70s, debt, especially federal debt, if you look here, was super low, right? So federal debt was super low, and even, private debt was moderate. And so they could raise rates to silly levels. They could raise rates to 15%, and it would cause a recession, but it wouldn't cause, like an insolvency event across the country. It would just cause a recession. Whereas back in this environment, because federal debt to GDP was 100%, they couldn't realistically raise rates to combat high inflation. And so they just pinned rates at zero or near zero, despite the fact that you had rather large surges of inflation. And so my theme for a while has been that the 2020s are shaping up like that. And so indeed, we're seeing a very large decoupling between inflation and interest rates. So they're just starting to raise interest rates slowly now, while inflation's already almost at 8% officially. And that's actually with changes compared to the 70s and 80s calculations. It would be higher using those same types of calculations, kind of the low to mid double digit range. And so they are kind of deliberately behind the curve. And that's in large part because, once again, there's so much debt in the system that they're unable to have structurally positive real rates. And so that's kind of the challenging macro environment that central bankers find themselves in, and that as investors, we have to navigate with our asset class selections. And I think, one of the contributors to inflation is changes in globalization. And so what both of these charts show is global trade as a percentage of global GDP, which if we were to encapsulate trade in one number, that's a decent one. And so, this is the longer term version. This version is from the World Bank. It goes a little bit, this one goes to 2017. This one goes to 2020. If I were to have a 2021, it would have rebounded a little bit. But as you can see, we have these periods of structurally more globalization. There's more trade between countries. And then you have periods of deglobalization. So, between the two world wars, as well as the era of trade populism between them, you had deglobalization. And then you had multiple decades of expanding globalization. The little surge here was because of a commodities boom. So you had just higher commodity prices contribute to higher trade just by definition. And, part of this downturn we've been seeing since 2008 is because of the decrease in commodity prices. So oil's off of its 2008 highs, and so that contributes to it. But also we have a very real kind of stagnant sideways action in globalization. So we're not exactly deglobalizing, but we're no longer globalizing as a percentage of global trade. And the reason that's relevant is because this whole kind of structurally disinflationary environment we've been in for, the better part of 40 years has been based on the premise that we arbitrage labor, right? So we brought a lot of cheap labor to offset wage increases. We find inefficiencies around the world and arbitrage them. It kind of create large and larger economies of scale. And if we do enter a world of more protectionism, uh, uh, more risk of warfare, less cooperation between countries, and commodity shortages, that's inherently a more inflationary environment that goes against a lot of the supply chain management practices of the past several decades. And so that's another reason why I think that the 2020s are shaping up to be like the 40s, because I think it's inherently a more protectionist, less globalized type of environment, which tends to be more inflationary, especially when you combine it with rapid expansions of the money supply. One thing we've been seeing in recent years and decades is that gold is doing a lot better than treasuries. And so what I have here is a couple different time frames. So if I were to summarize it, gold has done better than U.S. treasuries, including reinvested interest rates, year to date, over the past 1 year, over the past 3 years, over the past 5 years, not over the past 10 years, because you're going back from that bubble high, and over the past 20 years, right? So on just about any time frame, other than a very specific time frame, gold has outperformed treasuries. And the case for gold just got better in recent weeks because now a lot of countries have more of an incentive to hold or at least diversify into gold for their sovereign reserves, which unlike treasuries and foreign bank deposits, they can self-custody. And in addition, with this type of environment where rates are way below the inflation rate, those treasuries are melting ice cubes anyway, which is what they were in the 1940s. And so it's not that shocking to see that gold has been outperforming treasuries by one of its widest divergences ever. And I don't necessarily expect that pace to continue. But I think it's important, especially for a lot of investors that have 60-40 portfolios that were based on kind of a 40-year bond bull market, that it's just inherently more challenging now. This is a long-term chart of gold versus the money supply. And it's a little bit complicated, so I'll go through it. But essentially, the blue line's simple. That's just the U.S. broad money supply. Basically, how many dollars are in, commercial banks and currency in circulation. But most of it is liabilities of commercial banks. And the orange line is the estimate for the gold market capitalization. So it's gold price multiplied by the estimate total gold held above ground. So that includes roughly a 1.5% annual inflation rate due to new mining and very little destruction of existing supplies. And it's all normalized to 100 here in 1995. And so you can kind of see the relative growth. You can almost compare them like two different currencies, right? So one currency historically paid you a positive yield, but it increases, it has much higher monetary inflation. That would be the dollar and other fiat currencies. And then with gold, you get no yield. And in fact, you get a small negative yield because you have storage and security costs. But you have much slower inflation of the money supply, about 1.5% a year compared to generally, 7% a year or higher. And you can generally see that during periods of deeply negative real yields, which is the gray line on the right axis, that's when gold tends to have its big periods of outperformance. So this bump seems small, but that was actually a huge surge in the gold price. This, of course, was the very well-known surge in the gold price that led into 1980. Then, during this period, we had a strong gold bull market after a very long bear market. We got into bubble territory with as real rates started to pop back up, and then we went through a consolidation and new highs in an environment where, again, money supply is growing very quickly, real rates are negative, and so gold has been doing pretty well as a slice in a portfolio. My expectation is that it won't be a straight line, but that I continue to be relatively bullish on gold as an asset. The other alternative that central banks or people can turn to is Bitcoin. The advantage is you can potentially get higher returns over its 13-year history has done very well, obviously. It goes through big booms and bust cycles, but it's generally been a structurally up and to the right exponential chart. The challenge there is that it's still a rather small market. It's currently under $1 trillion market capitalization. And so it's not a large enough asset for central banks to really care about too much yet. It would have to be multiple times bigger to really catch their attention in that way. I consider it a useful diversification for investors as a slice in a portfolio. And I think that the whole summary here is that the 2020s are shaping up to be a decade where real scarce things matters. So commodities are scarce, productive assets are scarce, real estate in certain locations is scarce. As long as Bitcoin continues to function well, it's scarce compared to fiat currencies that are growing at rather rapid rates and they have negative real yields. And to avoid tail risks, investors can avoid over concentration into any one asset. And to finish up the presentation, equities are challenging in this environment. Generally, inflationary environments are not great for equities because they have trouble doing long-term planning when contracts are generally based on long-term pricing and inflation is running pretty hot. So you often have a mismatch in durations between outgoing cash flows and incoming cash flows. But then two, even if the company does well, investors will often end up paying a lower multiple for those equities as either bond yields rise or just as they discount at a higher rate. And so it is a challenging time for equities, but I do find that despite the fact that many equity indices are expensive, especially in the United States, there are interesting opportunities around the world. And so this, for example, is India's largest bank. They've run into rather significant headwinds recently. Obviously, they had COVID to deal with, and then they've had some company-specific IT issues that have kind of give them some regulatory burdens to worry about that I think that they're getting through pretty rapidly. And if you kind of zoom out long term, what's going on in India, unlike China, where they have a well-known property bubble with very high leverage, the Indian private households are rather underlevered, and real estate is pretty inexpensive compared to median incomes, at least compared to India's history. And so I think that the real estate sector has a long runway of structural growth ahead of it. Not talking about cyclical ups and downs, but structurally. And so the banking sector, which makes a lot of loans for that industry, I think still has a long structural growth trend ahead of it. So I do think that there are areas, for example, in India, that one can invest in. I think there are plenty of opportunities in select markets, select stocks. And on the other side of that, so of course, one of the big challenges of India is that they are a net commodity importer, right? So they're vulnerable to higher commodity prices. And so I continue to be structurally bullish on commodities as well. And this is just one example. This is Suncor. It's a Canadian company. And as you can see, I mean, they're in a position to rake in record income, record free cash flow, and they're doing very well. But of course, their share price is still suppressed. And that's the case for a lot of energy companies here, where the energy shares haven't quite priced in the idea that these higher oil prices are probably going to be here for a while. They're kind of fading this current spike, which is perhaps rational to do. I would generally fade war-related spikes as well, but because I continually have a bullish view on inflation generally, and generally bullish view on the supply side of oil, I continue to be rather bullish on that area. And I think it pairs well with something like an India investment, right? So if you're bullish on energy importers, one way to hedge that risk is to be long energy companies. And so I think that makes a nice pair trade to be long both, especially when both are individually attractive on their own merits. And so I think that, energy stocks in general, as long as you diversify jurisdictions and avoid too much single company risk, I still think there's a lot of long-term opportunity in the energy sector, even if there will be periods of time where it gets overheated. And so that'll end my core presentation. I'm happy to answer any questions that come up. If I were to summarize, I already summarized a little bit, but if I were to summarize again, I would say that, in many ways, the 2020s are resembling the 1940s in terms of fiscal policy, monetary policy, protectionism, things like that. And there's never a perfect analog. If anything, the United States looks a lot like the UK did in the 1940s. So in some ways, roles are flipped around. There's new players involved. and there's obviously technological differences, but that there are cycles in history that we can use. And we can also kind of look at breaking points and kind of turning points in macro to help us understand and catch some of the major macro trends that are coming this decade. Thank you.
Thank you so much for that, Lynn. We've got a ton of questions ready for you. The first one is, what is your view on gold? Should investors have a small portion, 1 to 5% of their portfolio, or should they have something like gold futures or gold ETFs, or even physical bullion?
So I think it depends partially on what exactly you're trying to hedge. I mean, one of the advantages of gold is it's one of the assets you can hold outside of the financial system. And so I do think it's worth having some self-custody gold. But in larger amounts, you want to avoid security risks and things like that. So I do view gold and gold miners and gold royalty companies as a useful slice in a portfolio. I generally am pretty structurally bullish on it. And it tends to be a decent uncorrelated asset. Sometimes it's going up with the S&P 500, sometimes it's going, down with the S&P 500, but other times they're going in different directions. And so, for example, in this recent period of equity weakness, the equity side of my portfolio has not been great, but the gold side's been holding its own, and somewhat surprisingly, the Bitcoin side's been holding its own. And of course, the commodity producer side's been doing pretty well. And so, if something's going down while other things are going up. And so I do find gold useful, especially, if I were to take a typical 60-40 bond portfolio, one of the first things I would do is say, okay, what can I do with at least some of this 40% bond section? Because we're in a period of financial oppression with yields below the inflation rate. And what do I want to do with that section? And, I might not, I wouldn't want to be 0% cash in bonds because it is useful against kind of deflationary shocks, cyclical rebalancing, kind of dry powder like that. But I would take some of it and probably put a certain percentage of it into gold. And I think that percentage can vary for people. I think, if someone does a lot of research on the industry and they're very bullish, they might want to have a larger segment. And if they're lower conviction or more concerned about it, they would have a smaller component. But I do think that a non-zero gold allocation in a portfolio does make sense this decade.
Thank you so much for that. And building off of that, the energy sector increases a lot every year to date. So do you think now is a good time to invest new money into this, or would you prefer the commodities sector?
So I think we were kind of in a period where U.S. shale, so we kind of had an unusual environment the past couple decades. So U.S. oil production peaked in 1970 and then rolled over. So we were in a period of structural decline, and we were more reliant on the Middle East. And that kind of changed throughout the late 2000s and then throughout the 2010s because we had a big rise of North American shale oil. And that might go a little bit higher, but I think most of that move is behind us, which brings us somewhat back to OPEC and brings us back to kind of traditional oil sources, which are the supply of those is not going up very rapidly. And so I'm still pretty bullish on the supply side of oil when looking out 5 to 10 years. Now, I think that it'll get overbought for periods of time. And I also think you can look at parts of the market that have not fully caught up with it. And so, for example, like I point out here, I don't think oil stocks have fully priced in, relatively high oil prices. Oil could come off of its current highs and just kind of chop around at, elevated levels, and it would still be great for oil companies. In addition, I think that there are attractive pipeline investments that haven't really, that they offer much better yields than you can get in treasuries, for example. And I think that the value of an energy pipeline just went up for geopolitical reasons. And it's actually getting increasingly harder to make pipelines. And so the existing ones, are attractive acquisition targets for other companies looking to expand. And so I think there are plenty of ways to play the energy sector long term. If anything, there are periods of time where copper got overdone because almost nobody disagrees that we're going to need a lot more copper going forward, whereas oil is still a rather controversial energy source. And I think overall that it's still rather value priced, and that's mostly unwarranted. I'm pretty structurally bullish on the energy sector for the next 5 to 10 years, even though there will be cyclical downturns.
Thank you so much for that. Next question is, as trading information and trading technology have changed, in a meaningful ways over the last decades. What do you see? I'm sorry. What ways do you see this impacting trading today compared to it impacting it in the past? And how are you adjusting your trading in these new meaningful technological adaptations?
Mainly by being an investor rather than a trader. And so basically the higher frequency and the more arbitraged and the more financialized market gets, the fewer inefficiencies are for the retail investor to find, or the family office, or the kind of the mid-level trader. And whereas the thing that there's still alpha in is getting ahead of major fund flows. And so, for example, by maintaining a globally diversified multi-asset portfolio and investing with a 5-year time horizon, you can find parts of the market that are super cheap and that are very kind of primed to go up in the next 3 to 5 years, um, and front run a lot of those kind of institutional cash flows. And so, there are markets where there are periods of time where American investors are have like record low foreign equity allocations, and foreigners have like record high US stock allocations. Like everybody's on one side of the boat, and then you can start picking out that other side. And you might look silly for 6 months or 12 months, but when you look out multiple years, if you pick the right types of investments for good fundamental reasons, eventually that thesis can do well, and that capital can start going back in. So if you find things that are mispriced and you just don't know when exactly everyone's going to realize it, it can be very useful. So, for example, there was a period of time where I was looking at uranium and no one was covering it, and then suddenly everybody liked uranium. Um, when oil went negative, if oil futures went negative in April 2020, and now look at them today, right? So, by being somewhat contrarian and by having a longer term view and by being able to kind of go between totally different asset classes, right? So gold, Brazilian stocks, US energy stocks, Bitcoin, whatever the case may be, if you just find markets that are totally unrelated to each other, that are attractive for their own reasons, and that the sentiment's washed out, maybe they just had a big correction, that's, I think, one of the few remaining ways for smaller or medium-sized investors to still have alpha in this rather efficient market.
Thank you so much for that. Next question we have is, given the high inflation rate and potential for rate hikes, should investors hold bonds, like you said, in a 60/40 portfolio, or should investors replace bonds with cash, gold, or other fixed income portions?
So fortunately, the answer is not like yes or no, right? There's a percentage answer. And so do I think that investors should have 40% of a portfolio in bonds? Probably not, unless it's a very specific trading call about, disinflation or deflation for a cycle. Um, in general, I think that it's worth replacing some portion of it. And that portion could vary depending on what your financial goals are. And so I like having a non-zero position in cash or bonds. There are disinflationary shocks that can happen where, pretty much everything goes down, and it's nice to be able to rebalance into that. Whereas there are more stagflationary types of environments where bonds are not that useful, and something like gold can be more useful. And even gold, I wouldn't put all my eggs in one basket in gold. I would diversify into Bitcoin. I would diversify into other commodities, industrial commodities, agricultural commodities, things like that. And so I think there's a case to be made to replace part of a bond portfolio, at least, with alternatives such as gold or other types of assets.
Thank you so much for that. Going back to your last answer, actually, long term, where do you see oil versus uranium and maybe lithium too?
So I don't cover the lithium market quite as closely. Lithium's pretty abundant. It's just a matter of mines for it. I'm structurally bullish on oil, gas, and uranium. I don't really try to pick which one's going to be the winner. I like both. There could be periods where they go up together. There could be periods where one does better than the other. I think we're undersupplied in terms of both uranium and oil, for the next few years. Perhaps uranium's a longer term view, um, because I think that, structurally, I think the world's probably going to appreciate nuclear energy a bit more and lean into that in the decades ahead. But I think that in the meantime, just where we are in terms of supply and demand, again, I think it can get overdone for periods of time, but I'm pretty structurally bullish on uranium along with oil and gas. Pretty much most types of energy I am bullish on for the 2020s decade.
Thank you so much for that. And talking about another sector, what are your thoughts on the technology sector?
So if you would have asked me this 6 months ago, I would have been less interested in it. Um, because we've seen such a washout in a number of tech names. So that includes rather blue chip companies like Adobe, for example. It includes foreign names that have faced regulatory pressures like the Chinese large cap tech sector, and a lot of the unprofitable ARC style names, Roku, Twilio, things like that. So many of them have been heavily washed out. And so I'm actually, I am more selective with that space because I do think that the 2020s will be a decade of like real stuff, value stuff, commodities. I think those will be kind of the looking back some of the big plays. But just like how energy and commodities and value stocks and inflation baskets can get overdone for periods of time, I also think that on the other side, I think tech can get washed out, overly washed out for periods of time. And so I do think that in many cases the babies have been thrown out with the bathwater and that there are rather attractive tech platforms out there. I would emphasize ones that have attractive economies of scale and that can scale very well. And so I think there are a number of them out there like Twilio and others that are at least attractive as small positions. I'd be careful of position sizing for unprofitable tech stocks. But overall, I do think that there are opportunities there and that they can serve a role in a diversified portfolio. I would not want to be 100% in an inflation trade and in a commodity trade.